U.S. equities moved higher during November, with large and small cap stock indexes both breaking out above well-defined trading ranges that they've spent the majority of their trading days within since early 2018. As equity markets moved higher, we witnessed bullish sentiment outpacing bearish sentiment for the 8th consecutive week, which is the largest streak we've seen since early April. And we also witnessed investors drawing down money market balances in the most meaningful way since early April 2019. Foreign stocks also moved higher during the month in local currency terms, partially due to expectations and optimism around a potential Phase 1 trade deal before December 15th. Returns in US dollar terms, however, were more muted as the US dollar strengthened during the month relative to most foreign currencies. Most notably, we saw the Chinese Yuan, which had previously strengthened slightly back above the key 7 Yuan per US dollar level, eventually break lower during the month and move back below that key technical level. The U.S. Treasury yield curve was virtually unchanged during the month, resulting in roughly flat returns for most fixed income asset classes. Importantly, we saw measures of funding stress within short-term funding markets subside considerably during November compared to the severe levels of stress experienced in September and October. The Fed's recent new liquidity measures have been in very high demand. The size of the Fed's balance sheet has grown by over $300 billion since they started injecting emergency liquidity into the repo market and purchasing treasuries following the repo blowout during mid-September. In one of our recent video updates titled Examining the Bull Case, we noted the potential for stocks to move higher into year-end due to a confluence of short-term technical factors, including investors becoming increasingly pressured by short-term performance incentives as we head into the end of the calendar year. This is something we saw evidence of during the month of November. As long-term prudent fundamental investors, we remain reluctant to chase returns during a time when asset prices are at extremely high levels historically and are increasingly not being justified by the fundamentals. For example, as the S&P 500 has recently been making new all-time highs, Q3 2019 earnings came in at negative 2% year-over-year growth, and expectations for Q4 2019 have come all the way down to negative 1.5% year-over-year growth. If this ultimately comes to fruition, this will be the first time the S&P 500 has experienced consecutive quarters of negative year-over-year earnings growth since late 2015, early 2016, a time period that was very difficult for global equities. As a result, our overall portfolio positioning remains unchanged month over month, and we continue to believe our defensive posture is justified by roughly all of our leading fundamental and valuation-based indicators.